Hello, this is Tim Congdon, Chairman of the Institute of International Monetary Research at the University of Buckingham. This is the monthly commentary on monetary trends. In principle, it should be about a number of countries, but at present I'm focusing very much on the United States of America, which is, after all, the world's largest economy. And indeed, America illustrates the patterns that I want to talk about. These patterns are very alarming and need some analysis and discussion. It's at the end of April 2020. The alarm, concern, and so on about the coronavirus is more or less at its peak. And I want to explain how this is impacting on the American financial scene. I talked about this subject at the end of March. I gave a presentation on the 22nd of March, and that was, well, I said some things there that might have wanted to make you fasten your seatbelts as far as money trends and inflation were concerned. Well, a lot has happened since then, so it's now a question of fasten your seatbelts and, if you can, try not to press the panic button. This is what I was saying the 22nd of March. I was expecting that there'd be an increased budget deficit compared with 2019, and that the growth of the American quantity of money, it's very important in our work, would move up towards double digits, just towards double digits, and this would then mean inflation risk over the medium term. Everything has now changed. It changed so dramatically in about a fortnight after President Trump announced national emergency, and then the Federal Reserve made announcements and so on. And some of this we could see in the weekly figures from the Federal Reserve on what's happening to bank balance sheets. Anyway, I am now expecting that the growth of American money on the broad measures will move up towards 15-20% at an annual rate in the balance of 2020 and early 2021. It could reach the highest figure in American peacetime history. And the implications are indeed for rising inflation, possibly to double-digit rates, at some point in the next 2 or 3 years. Now, what I'm going to say in the next few minutes is quite complex, so I hope you'll forgive me if I look at my crib sheet. I'm going to be using, to a large extent, actual numbers that are available from the Federal Reserve. The 4 key points in my argument are as follows. There's a large budget deficit. There's also commitments on the part of the Federal Reserve to help banks, lending to companies that are subject to cash drain because of the coronavirus and the lockdown. These 2 developments will tend to cause faster growth of the quantity of money, because the government will have to finance its deficit in large part from the banking system, to some extent from the central bank itself. There is then, in the medium term, a relationship between the change in the quantity of money and the change in nominal GDP. Very well established relationship, which we emphasize a lot in the Institute's work. And this then means that a major increase in inflation is to be expected. Now, in the 22nd of March presentation, I gave a picture of the rise in the American budget deficit from 2015 through to 2019 and then 2020, as was then expected. Deficit was expected to be around 8% of GDP, a very high figure, but, well, we must have moved on. And the figure now is, the talk is of a budget deficit in America of around about $3,000 billion, possibly a bit more, getting on for 14% of GDP, and this is, for peacetime, an all-time high. So at least in terms of the budget deficit, we are at peacetime records. Of course, this is an American presidential election year, and so it's hardly surprising that the government isn't prepared to be tough, but in fact they are dishing out money left, right and centre to help people who are suffering from the lockdown and the other measures taken against the coronavirus. A large part of the increase in the deficit reflects payments, so-called austerity, stimulus checks, checks that are part of the so-called stimulus that's been given to the economy from these measures. And these are of $1,200 per person, $2,400 per two-person household, and also $500 for each dependent child. These payments were mostly made in the week to Friday the 17th of April. The total fiscal cost is put at about $300 billion. That's quite a large part of that expansion of the deficit that I've just shown you. Now, this is a classic example. The government spends money, and there's extra bank deposits in the economy because of this expenditure to help people through this period of difficulty. Much of it will come through, of course, in the Federal Reserve dates for the balance sheet numbers are the 15th and 22nd of April. We'll be seeing those very soon. We have already had figures for the American banking system through late March and the first week or two of April. And in March, US broad money rose in one month by 3.9%, according to shallow government statistics. 3.9%. That figure, by the way, is higher than is in some recent years, just in the 1 month. In the weeks to 18th of March, 25th of March, 1st of April, and 8th of April, bank deposits rose by 2.2%, 2.6%, 1.0%. They actually fell a little bit in the 0.1% in the week to 8th of April. That's all official data. So in that 4-week period, bank deposits, most of the quantity of money, went up by 5.6%, and that would actually translate into an annual rate of increase of 105%. It's extremely high growth rates of the quantity of money. On top of that, we've got these payments being made, $300 billion, in the week to the 17th of April, some affecting, in the Fed numbers, the week to 15th of April, some the week to the 22nd of April. I suggest that in those 2 weeks, bank deposits will rise again by about, say, $300 billion. Now, if you make that assumption, which I've explained why I've done it, then it follows that in April, the quantity of money broadly defined will rise by somewhere between 4 and 5%. That's just what the figures mean. Okay. Let's then try and look at what this means relative to the recent past, money growth and so on. Now, this chart, I haven't got April in here. The last number is March. You probably can't really see at the very end the surge that's going on at the very end because it's just only 1 month. But most of this period of the 2010s, very moderate growth of the quantity of money, an average about, say, 4%, maybe 4.5% a year, that kind of number. Growth of nominal GDP, 4.5%. Very low inflation, a lot of stability, very good. And then at the very end, you see it starting to edge up through 2019, and then this explosion at the very end. Now, this is a somewhat shorter time frame, only the last 3 or 4 years, and we've got at the end, including April now, acceleration in the 3-month annualized growth rate up to about 45%. And the annual rate of increase of money on this estimate, my estimate, is 16%. We're into that 15-20% band already. And this chart shows you that these what's happened in March and April are completely out of line with recent experience. And that reflects the dramatic nature of the announcements and the very, in a sense, liberal response on the part of the administration and the Federal Reserve to the problems created and the hardship that's being created by the lockdown because of the coronavirus. The budget deficit will remain at very high levels through the rest of 2020, probably much of 2021. The problem of financing it will remain. And on top of that, there's been government support. Federal Reserve is also involved in helping banks lend to cash-strained companies. There's a whole sequence of programs and things here. There's a primary market corporate credit facility. There's a $350 billion small administration loan program. There's a potentially $1,000 billion temporary corporate and small business liquidity facility. I put it to you that not only will the government be borrowing to a large extent from the Federal Reserve and the banks to fund its enormous deficit, but also you're going to be getting loans to companies with government guarantees, which again will boost the quantity of money. So I don't think it's impossible that the rate of growth of money in the USA will move up to 20%. I think it's going to be in this 15-20% band for some time. Now, you can have a discussion then about what this means for the economy, for nominal GDP and so on. One of my heroes is Milton Friedman. He said that it isn't silly to assume that at first approximation, the world's complicated, we know that. The first approximation, the velocity of circulation is constant. The change in nominal GDP will therefore be equal to or similar to the change in the quantity of money. By implication, with a 15-20% rise in the quantity of money, we're already at 16%, all right? At some point, US nominal GDP growth, next year or two, moving up towards this 15-20% band. Okay, we can debate and discuss this, I know that, but that is what's implied by the analysis I've just given. This shows you a histogram of the changes in the velocity of circulation, annual change going back, quarterly data going back to the 1960s. In fact, the mean value is about -0.5%. It is normally distributed. And there are very few extreme values. This argues that there should indeed, our central expectation should be a dramatic acceleration in the rate of increase of US nominal GDP. Now, let me admit straight away, I don't know exactly what's going to happen quarter by quarter. It's very clear that in 2020, there's going to be a fall in nominal GDP, so a dramatic fall also in velocity, because obviously money growing at kind of 15-20% and nominal GDP actually going down a bit. But then what happens through in 2021 and 2022 when in all the history these things reassert themselves? I don't know the precise quarterly course of inflation, GDP and so on. All I know is that there's a very difficult adjustment problem coming up out there in the next few quarters. Of course, at the moment, there's the oil price fall, which is going to dampen down inflation. That may lead to some complacency. You may think that, in fact, the worry is deflation, not inflation. Okay, each to his own. In my view, there's a lot of analysis, a lot of previous history, a lot of theory behind the forecast that there'll be a sharp increase in American inflation in the next 2 or 3 years, just as there was after somewhat similar circumstances in terms of the challenge to governments and policymakers, similar challenge after the First World War, the Second World War, and by the way also the Vietnam War. All of these were followed by a sharp increase in inflation in the United States. You might say that it isn't really inflation. What we've got is a one-off change in the price level because of a shock. Well, I understand. And it may be that, the Fed administration, by 2023, all this is history, and money growth is back down at 3 or 4%, inflation's back under control, bond yields haven't changed very much, and so on. Maybe. All I would say is that between now and then, there is an adjustment problem. Okay, I'm going to finish just by giving you my own thoughts about this wider question of the coronavirus and how policy should have responded. I don't think there was, in fact, much that politicians in democracies could really have done other than what they've done. Having said that, in my view, this has been out of all proportion to the challenge that they faced. In the world, population 7,600 million. In a normal year, about 60 million people die. So since the Wuhan lockdown began in late January, about 15 million people have died globally as a normal course of events, various ailments and so on. Number of people who have died, according to the figures, various places, Johns Hopkins Center for Discussion of the Disease and so on, 150,000 people have died from the coronavirus, 0.1% of the total. Now, it's true enough in some countries that the number of excess deaths is rising much above that. I know that. All the same, there has to be some questions asked about whether what's been done is sensible. What I'm very confident about is that getting fiscal and monetary policy back on course, even in the United States, the world's dominant economy, the next 2 or 3 years is going to be very difficult. And inflation is all too likely to reach double digits. Thank you.